One equation, $4 trillion industries. But here's what nobody tells you. It all started with a gambler's obsession, a forgotten physicist, and the secret language of atoms. Isaac Newton, the man who literally invented physics, is about to make the worst bet of his life. Newton doubled his money in April, sold out like a genius, then watched helplessly as prices kept climbing. By June, he couldn't resist. He bought back in at the peak. When the crash came, Newton lost 1/3 of everything. His response became legendary. I can calculate the motions of heavenly bodies, but not the madness of people. But what if I told you someone did find a way to calculate that madness? Enter Louis Bachelier, 1900, Paris. A man nobody remembers who discovered something everyone uses. Both his parents died when he was 18. He had to run his father's wine business. But Bachelier had a problem. He was too curious, so he sold everything and moved to Paris to study physics. To pay the bills, he got a job at the Paris Stock Exchange. And there, in the madness of 200 traders screaming prices, he saw patterns. Options weren't just contracts. They were time travel for money. The ancient Greeks understood this. Thales of Miletus, 600 BC, didn't have enough cash to buy olive presses, so instead, he bought tomorrow at today's price. Options let you bet on the future without fully committing to it. But nobody could price them accurately until Bachelier realized something nobody had seen before. Stock prices, Bachelier discovered, move like drunk people leaving a bar, completely random, yet somehow predictable. Here's where it gets weird. The exact same math that describes stock prices also describes heat flowing through metal, smoke spreading through air, and how atoms prove they exist. In 1905, Einstein used this random walk to prove atoms were real, but Bachelier had discovered it 5 years earlier. And nobody noticed. Why? Because traders weren't ready. The missing ingredient, a way to make obscene amounts of money. Fast forward to 1960s, Las Vegas. Ed Thorp wasn't your typical physicist. He had a superpower. He could remember cards. Thorp invented card counting, not by gambling instincts, but by treating the casino like a physics experiment. When odds favored him, bet big. When they didn't, bet small. But casinos caught on. They added more decks, diluting his edge. So Thorpe looked at the biggest casino on Earth, the stock market. And here's his genius move. He figured out how to manufacture risk out of thin air. Imagine this. Someone bets against you. Normally you'd lose if they're right. But Thorpe discovered that by constantly rebalancing, buying a little stock here, selling a little there, you could neutralize the bet. You'd already locked in your profit, no matter what happens. This is dynamic hedging, and it meant something profound. You could sell insurance you didn't actually own. You could create options from nothing by just trading strategically. Two economists, Black-Scholes, alongside mathematician Merton, published the equation, the one that changed everything. But here's what made it revolutionary. For the first time, you could take anything, a stock, a bond, a barrel of oil, a Bitcoin, and calculate exactly what a bet on its future should cost. Wall Street went absolutely insane. Within 2 years, every major trading floor had programmers coding this formula into their systems. Why? Because if you knew the real price and your competitor didn't, you could steal their lunch money every single day. The options market exploded from basically nothing to hundreds of trillions of dollars. Multiple times the size of the actual stock market itself. Now everyone knew the equation, so how do you win when everyone has the same playbook? You need to be smarter than smart. Enter Jim Simons. Simons wasn't a trader. He was a mathematician who helped build string theory, the physics of literally everything. In 1988, he decided to aim that genius at Wall Street. The Medallion Fund returned 66% per year for 30 years. Not 6%, not 16%, 66%. How did they do it? Hidden patterns. While everyone else was looking at obvious trends, Simons hired physicists to find the invisible forces, like discovering atoms by watching how they push pollen around. But here's the ultimate irony, and it's beautiful. The more people discover patterns, the more they destroy those patterns by trading on them. Every secret becomes public. Every edge gets eliminated. January 2021, the entire world watched as Reddit trolls weaponized Black-Scholes against Wall Street itself. GameStop wasn't just about stocks, it was about options. Here's the weapon. With $1, you can buy $1 of stock, but with options, that same dollar can control $10, $20, even $50 worth of stock. Wall Street had been using this leverage for decades to crush small investors. But in 2021, the small investors learned the trick, and they used it to make hedge funds bleed billions. So, what did we learn? An equation born from studying atoms, perfected by a forgotten wine merchant, weaponized by a card counter, and turned into a money printer by a string theorist. But here's the final twist, the thing Newton never understood. You can't predict the madness of people, but you can predict the patterns in that madness. And the more we find those patterns, the more we destroy them. It's like the universe is playing a cosmic game with us. The market will never be fully predictable, but it will also never be fully random. Because every time we discover a pattern, we change the game. And somewhere, right now, a physicist or mathematician is discovering the next pattern that will spawn the next trillion-dollar industry. The equation didn't break Wall Street. It transformed it. And the game is far from over.